Welcome to the Monocle Banking Podcast, as always, curated by Monocle Solutions. I'm your host, Michael Avery, and today we're talking private equity. And Southern Africa's PE industry has just delivered its strongest year of deal making since 2018, deploying over 26 billion rand across 228 deals in 2024. That is despite a brutal 70% slump in fundraising, heightened geopolitical risks, and an uncertain economic backdrop. The new released SAVCA Private Equity Industry Survey points to some cautious optimism in the industry, some resilient portfolio companies, and some surprising strategic pivots. But it reminds me of the old private equity adage that you make your money when you buy and not when you sell. So what does all of this mean for the outlook? To unpack the findings, I'm joined by Graham Stokoe, who's EY Africa Private Capital Leader, who also led the research team behind this year's survey. Together, we'll dive into the numbers, the strategies, and the future trajectories of private equity in Southern Africa. Graham, great to have you on the podcast this week. Despite that sharp decline in fundraising to just under 8.5 billion rand, the industry achieved its highest deal-making value since 2018. Is this just a cyclical event? And what were the underlying factors propelling those headline numbers?
Yeah, I think, Michael, I would say the cyclical bit is probably the fundraising. And so when you look at the deal making, the fundraising was at an all-time high at just over 28 billion in 2023, plus pretty high fundraising over 2019 all the way through to 23, above 16 billion each year. So you had quite a lot of dry powder. And when you think about the environment pre-elections, there was a lot of uncertainty, not just elections here, but elsewhere. I think environment slightly more conducive to deal making being done, particularly post-April, led to more deployment and of that. And then back to the fundraising, the cyclicality, we definitely saw a drawback out of overseas investors, particularly the DFI. So again, political events, but particularly elections throughout Europe, US, and various other jurisdictions probably didn't make fundraising too easy in 2024. And then even locally, it was down, but also the cyclical, there was some big infrastructure funds raised in 22, 23, and those came to an end in 24. So a number of factors probably culminated in that sort of fundraising really dropping off sharply. But I do foresee it coming back. And even in our, let's call it more qualitative bit of the survey, both fund allocators as well as PE firms themselves expect an increase in fundraising in 25 and going forward.
So I guess unsurprising that, we saw the record amount of dry powder raised the year before, that GPs would then shift to deploying existing capital more effectively. And just to your point on where we are in the cycle as well, interesting that if you look at the sectors, infrastructure led the deal flow at 27%, followed by energy and IT. Can you maybe shed light on the sectoral shifts driving investment, and are there other emerging sectors that investors should be watching?
Yeah, I think firstly, quite clear on the energy and infra side, a lot of the fundraising in 23, but also in 22, a little bit in 24 was a lot focused on infrastructure funds. So we can see that strong correlation. On the IT and technology side, I think that's more of a shift over medium or longer term to businesses that is hopefully, I guess, going with the change of the overall business environment and seeing growth in disruptive tech businesses. So we do see that globally. I just don't think we've seen that shift into technology locally as much as it's the case globally.
And with 2/3 of portfolio companies reporting revenue growth above inflation, over 40% increasing employment, I think that certainly stands out in the South African context where most companies are ex-growth and certainly not adding jobs. What does this suggest about the real impact of PE on regional economic development?
It's a huge positive. It really shows how PE does economically impact the economy as a whole. These are clearly, I would say, above sort of average things, but does also show PE is investing behind high growth businesses. We also see it by the type of investment, particularly in Africa and Southern Africa, into capital raises and and not just leverage buyouts and cost-cutting measures.
Interestingly, we've seen an increase in exits through public markets. And I think that's quite encouraging because for a number of years, it has felt like the IPO to public has certainly been fairly narrow, and that window seems to be opening. In past cycles, it was very much exiting to other trade buyers or MBOs or that kind of thing. What insight can you share on the potential for public market exits to become more common in the region?
I would love to say I'm optimistic about it being more common, but unfortunately, yes, there was one exit through IPO, not in South Africa. And I think for now, it's not a very common route. I think on the very, very sizable, obviously, we saw Premier Foods IPO, I think it was year before last. But yeah, I think for the short term, I can't see a huge shift into looking at IPO as a sort of key exit route. And I think exiting to other financial and PE buyers as well as trade will continue to be the main exit routes that PE look at.
What potential impact might that then have on valuations? And if you were to say that, I mean, you're exiting to other financial buyers or trade buyers, does that put downward pressure potentially on this vintage?
I think it possibly does, and it really depends on which trade buys and then the overall cyclicality in valuations and demand for high growth businesses. I think for now there is potentially it is difficult to exit well, and the reason why I say that is the trade buyers been slightly less and the P buyers and various street buyers becoming more active. And I think worryingly is the exits to international trade. There is or they have been, but I think we'd like to see more exits to international trade, which typically can attract higher valuations and higher returns. So bringing, I guess, multinationals looking at South Africa more than less is what we need going forward.
Do you think it's an area where private equity general partners could do with a bit of external help? Often in private equity, the joke goes, someone works in private equity because they're the first ones looking for the exits when they walk into a room. So it is part of the strategy. You have some kind of idea as to who you're going to exit to and when and how. But things change. We know how volatile the market can be in a 7 or 5 to 7 year period. Do you get a sense that GPs need to bring in exit deal making specialists to ensure that they get the best possible multiple at exit?
I would definitely say so, particularly when you, as I mentioned, looking increasingly at international trade because, well, the Ps locally are probably very familiar with the main local trade buyers. As soon as you're looking to sell globally, it's a much bigger universe, but selling SA Inc., getting the right trade buyers, getting them aligned with the business, familiar with the business, and then nuances in South Africa like triple B, double E, or various other nuances is obviously needing a lot of support and preparation, a lot of effort needed to get a very good, successful sale to a multi-trade away.
Are you seeing any notable differences in the deal mechanics, such as structuring or financing or negotiating tactics between domestic deals and cross-border transactions?
Yeah, I can't say we've seen notable differences. I think for a while you saw a lot of protection on valuations with earnouts and sort of amounts linked to, but that was more sort of immediately after COVID and quite a bit of uncertainty and therefore people hedging their bets. I think over the last 18 months, 2 years, it's gone back to more traditional deal making. It'll be interesting to see how it develops over the next year or so.
What really stood out for me was the surge in private credit, which is something we've discussed on my other platforms in the past, Graham. And the survey now shows 86% of Southern African PE firms now pursuing private credit, up from just 50% last year. Yet it still makes up only 6% of funds under management. What's driving this explosion of interest, and how much of it is genuine conviction versus maybe a bit of a survival strategy in the face of weak fundraising?
Yeah, look, I think globally, private credit is one of the fastest growing asset classes within private capital as a whole. I think with interest rates going up for a while, and I know it's in a down cycle now, there was that drove a lot of interest. And then when returns have been lower than, say, they were previously, private credit becomes a lot closer to, say, returns in just pure private equity. So it'll be interesting to see, as you point out, that sort of huge contrast between actual capital deployed versus total private equity versus the huge interest levels. And I think private equity is looking to diversify into asset classes, particularly private credit that is possibly slightly lower risk, but returns slightly lower. But given private equity returns have possibly not been too good over a number of years, that difference has become a lot less, which makes the private credit side a lot more interesting.
And obviously, with the traditional banks being squeezed by regulation through Basel, their ability to lend is constrained. And so you get private credit stepping into that breach. And globally, you've got firms like Apollo and Blackstone. They've built credit arms that I think rival their equity businesses. Do you see Southern African firms going down a similar path, or will private credit here remain more of a complementary strategy rather than a transformational one?
It feels like it's more complementary right now, but you're totally correct in that opportunity exists in a risk-off environment, which I think we have been in, where banks are deploying less credit or less aggressively, and there is a market for astute investors to really investigate potential opportunities and deploy private credit using, I want to say, more private equity principles, looking at cash flow rather than hard security that the traditional banks and traditional financial services look at. And there lies the opportunity in the sort of capital light businesses, but cash flow heavy businesses that maybe the banks in a risk off environment are not serving as much as they would in a very growth market, which hasn't been the case over the last couple of years.
I guess the one thing we should probably watch out for, though, Graham, is crowding out equity, because if more PE managers are deploying into credit, we might run the risk of starving equity-hungry businesses, especially in the SME space, of that kind of long-term patient capital that they need to scale. I'm not sure we're anywhere close to that yet, but might be something to watch out for in the future.
Yeah, that is true. And that's why I say it feels like a lot of the private credit interest has been with the existing private equity firms and almost trying to look at providing multiple solutions or, private pure equity versus a private credit solution, and therefore, I guess, providing a better overall capital solution to high growth entrepreneurs. And a number may look at that sort of private credit option more favorably, particularly if succession planning and they don't want to achieve a massive exit, but they want to use the capital to grow and then to buy the PE over time. And that's the advantage of private credit and that the entrepreneurs can still keep in control of their businesses.
I want to turn now to the new introduction. LPs, the limited partners, the funders, they often the hidden power brokers in private equity. And this year's SAVCA survey gives us their perspective for the first time. Why was this inclusion important for you? Maybe let's just start there and the decision to include them. And then very broadly, what did their responses reveal that we might not have seen if we only focused on the GPs?
Yeah, I think it's an important aspect to look where, at least locally, a lot of the capital comes from, because that drives the types of mandates that PE firms have, and it drives the overall sector because they are the capital funders sitting on top. So interestingly, when we launched, or not launched, but we had an event last year, or SAFCA had an event last year, we got a panel with allocators with PE firms and had that joint panel. And the PE firms were really receptive to that change in audience and structure of an event when the survey was launched last year. And that, I guess, stimulated the idea of getting allocators' inputs on a discrete part, particularly the sort of capital coming in and where it's going and where they would like to see it going, and some of the other aspects such as ESG and transformation.
But I see ESG ranking as the top strategic priority, while GPs still lean towards product strategy expansion. What does that tell us about a possible misalignment here between what investors want on the one hand and what managers are focused on delivering?
Yeah, I mean, I do think the allocators have the ESG super high on their priority. I mean, I still think commercial returns is like they probably think, well, that's a given. We want to emphasis maybe what we don't feel is a given. So maybe it was an emphasis of them, but I'm sure they definitely want the commercial returns as well. So I can't say there's a massive misalignment, but it was interesting to see the differences on very similar questions of priorities from the allocators versus what PEs were saying as their priorities.
And Southern African allocators' biggest concern wasn't geopolitics, but it was oversaturation and a drying up of deals. And I think with a record 228 deals last year, but the question is whether they're signaling that too much money is now chasing too few quality assets. How should GPs be responding to that?
Yeah, I think, and that's why it's insightful to see this view, which caught us by surprise a bit, particularly given the huge deal making that we did see. But it shows the value and that allocators maybe not be as close to the overall environment as one thinks, and therefore this kind of research and outputs is important, so you can be better prepared in going into discussions with allocators and be aware that they may not be as close to the deal making environment as PEs potentially are.
And infrastructure, I think no surprise there, was seen as a top priority. And I mean, if you just look at South Africa, we've been having this conversation for what feels like an eternity, Graham, that every year there's a State of the Nation address and the president says we need greater public-private partnerships. We feel it as citizens, the pressure on the water infrastructure, roads, if you live in Johannesburg, seem to be falling apart. We need more healthcare facilities. Energy is probably the one area where we really are stepping up and delivering. What would you say the bottlenecks are for greater private equity participation to really step into the space meaningfully? And what's holding back faster capital deployment?
If we look at what has been successful, and you point out the energy side, I'd probably point out the digital infrastructure side. I think it's turning those infrastructure opportunities into projects that are commercially not only viable, but commercially attractive. And I think it's turning some of the other infrastructure challenges into, I guess, problem solving is how do we turn this into a private sector opportunity that is commercially viable? Because it's clear that allocators have let's call it a bigger agenda and a number of agenda items outside of the pure commercial. I think to make it work in a private equity context is to turn it into commercial projects and opportunities.
And I think there's a scale issue, isn't there, as well? Because infrastructure projects often need billions in long-term capital, yet most Southern African PE funds are mid-sized. Are we seeing a mismatch between the scale of the country's infrastructure gap on the one hand and the firepower that PE firms can bring? And how do you solve for that gap? Do we see greater syndication, partnerships, or something else entirely?
You probably are correct. And I think it depends on the types of infrastructure opportunities. Some are just of such scale and such numbers that is just very difficult for private equity to come, given the, I guess, limited capital. And as you say, you'd have to team up. But I think there's a number of infrastructure opportunities, and it does come back to that sort of huge fundraising that, significant, more than majority of capital has gone into that infrastructure and energy, where it is above average investments and large value investments. But as you say, there probably are a handful, not only because of scale, but sometimes because of, call it too new or too high risk, whether it be the sort of hydrogen side or others, which the infrastructure has to be proven to a great extent to get private equity interest.
Looking ahead, I see roughly half of PE managers expect increased deal making into the rest of this year and the last few months of the year. What sectors or markets are poised for growth here, and what could further influence this outlook, given what we've seen globally with a lot of pressure now on the Fed to start lowering rates? There's a lot of concern in the world around developed market debt. Long-term bond yields are rising. Gold and precious metals are shooting the lights out. It's telling you that it doesn't feel like a very risk-on environment.
No, you're right. And I think, if we were having this conversation this time last year, I think we would have been lot more risk on for 2025, but unfortunately there's been a lot of noise, particularly globally with the trade wars, and that makes deal making more uncertain, more hard. And I think when I say one has to just be more prepared and more closer to the microeconomics and looking at businesses and really with open eyes on what are the potential impacts from macroeconomic instability and changes happening worldwide. So it does make it more challenging, and for me that probably means more of the deal making in risk off type of sectors, whether it's healthcare, just more certain revenue streams and less volatility, maybe as you say linked to commodity mining services, the services linked to infrastructure, everything that's on the side of some of these high growth areas.
For allocators, pension funds or DFIs or even family offices listening to this podcast, what's your message? Where should they be putting their incremental rand or dollar or euro in the South African private equity story?
Yeah, look, I think a lot of capital came in a couple of years ago, and there were a few fund of funds, particularly on local black-owned PE funds. I think that dried out quite a bit last year, and one has to look at let's call it version 2 of that, and where is more of this capital going forward, particularly to the local black-owned PE firms established sort of 4, 5, 6 years ago. And I think there's a lot of opportunity. There's been a lot in the mid-market. I think the very large scale of private equity is a lot more uncertainty, and to see who's going to come out in that sort of sizable PE investments is a question mark going forward because of changes that have happened over the last 5 or 6 years in that sort of upper part of the market. But in the mid-market, lower mid-market, I would say there's a decent amount of capital, but there's a version 2 of local allocators looking to deploy more capital in that space, which will be interesting to see this year and going into next year as well. But by the sounds of it, from what we heard, allocators, there's a lot of interest, which is great to hear.
That is a fascinating conversation, Graham. Thanks so much for helping us unpack not just the numbers, but the deeper dynamic shaping private equity in Southern Africa. Take care.
Thanks, Michael.
Well, from the paradox of weak fundraising but strong deal making to the rise of private credit, the allocators' louder voice and the undeniable need for infrastructure investment, the industry certainly sounds like it's at a crossroads. As the old saying goes, capital goes where it's treated best. The challenge for Southern Africa's private equity industry is to prove it can treat both investors and the economy well, generating returns while building resilience. That's it for this edition of the Monocle Banking Podcast. I'm Michael Avery. Join us next time as we continue to explore the ideas and the capital shaping our future. Don't forget to like, subscribe, and share.